Hey everyone, this is Brian from Green Springs Capital bringing you your weekly updates. This week I want to continue the conversation about depreciation. This is the third pillar of our investing strategy with Green Springs Capital and why we love multifamily real estate development so much. So if you remember before from last week, depreciation is a paper loss that allows you to reduce your taxable income each calendar year and effectively pay less taxes now. You're basically deferring those taxes to a future date where you might sell the building. To continue the example we had last week, we talked about $1 million property and you have to subtract off the value of the land. So now you have $800,000 asset that you can depreciate over 27 and a half years. So you simply take $800,000 divided by 27 and a half. That's straight line depreciation. And you can use those losses on paper every year to kind of reduce your taxable income. Let's take that one step further. So today I want to talk about cost segregation. So cost segregation is kind of a more advanced version of this straight line analysis. So instead, with cost segregation, you hire a firm, an engineering firm, they come out and they kind of break down the building into 5-year, 15-year, and then the rest is all still the 27.5-year buckets, for lack of a better term. So you might have appliances or furniture or lighting fixtures or something like that. So effectively, those have 5-year lifespans. So you could take a portion of your $800,000 and say, oh, well, $200,000 of it is 5-year product. Another $200,000 might be 15-year, and then all the rest, the $400,000, would stay in that 27.5-year timeline, effectively stating that that part of the building will last the full 27.5 years. The value in doing this is, in that same example we had from last week, we ended up with $50,000 in net operating income, and we ended up with about $29,000 in depreciation if you use straight line depreciation. If you do a cost segregation study, the numbers are a little bit different, because if you have $200,000 in a 5-year bucket, $200,000 in a 15-year bucket, you're dividing those numbers. Immediately you can take that in the first 5 years off of your taxable income. So let's go through the math a little bit. So if you do that example as I just stated, $800,000, and you just assume $200,000 of that is 5-year asset, $200,000 of that is 15-year, and then all the rest, the $400,000, is the full 27.5 years. So what that means is in year 1, you'd have a depreciation taxable paper loss again of $67,878. You'd have that same loss every year for the first 5 years. And then from years 5 until years 15, you'd have a slightly reduced loss of $27,878. How I'm getting to that is you take $200,000 divided by 5, and then you take $200,000 divided by 15, and then you take $400,000 that remains and divide that by 27.5. You add up those three numbers, and that's your losses for each of the first 5 years. After the first 5 years, that 5-year bucket burns off, and then you just have the 15-year bucket and the 27.5-year bucket. Add those two numbers together, which is effectively equals out to $27,000 a year. This sounds a little bit overly complicated, but the value in cost segregation is you can advance the losses from future years into the near term so that you can further reduce down your taxable income and effectively not pay tax on the cash flow that you're pulling off of the property from operations. So we do cost segregation studies on every single property that we buy because we have this strategy that enables us to do a lot of renovation work. So not only are we doing cost segregation studies on the front end when we buy the building, but then after we do renovations, we do it a second time. So we get to capture that second bundle of additional depreciation based on all the money that we've invested in the property, in new products, new appliances, new flooring, etc. So we're doing cost segregation studies on the front stuff, on all the old materials, and then we do it again on the back end for all the new materials so that we can maximize our depreciation losses in the near term, which allows us to keep more money in our pocket and allows us to reinvest and buy more properties in the near term. The longer you can keep the money in your own pocket, the more you can reinvest it and the more you can kind of compound those returns that you're gaining from investing in real estate. So that's a long-winded way of explaining cost segregation as it relates to depreciation and a more in-depth analysis of why we love tax deferral strategies such as this and how it kind of can impact your investment in multifamily real estate. So that's it for this week. Thank you for checking in. As always, you can send us messages here on Instagram at Green Springs Capital and have a nice weekend.